Good morning, good afternoon. Just give it another 30 seconds for a few more people to trickle in, and then we'll get kicked off. All right. Good morning. Welcome everyone to the SevenBridge April webinar. There's obviously been a lot going on, so this will be action-packed. So just to kick things off, I'm Justin Ferraccio. I'm one of the partners here at the firm, and this is Chuck Eberly.
Good morning. Happy tax day.
Happy tax day. Enjoy. I think everyone on the call should know both of us, at this point, but if not, reach out. We'd love to spend time with you, getting to know you better. I know we have some new faces on the call today, some friends of the firm. So welcome. Thank you. So as always, this is just kind of a reminder of the cadence and what this is meant to do. I'm going to share my screen. This is, meant to be kind of a monthly update on what we see going on. It's not always going to be market related. Sometimes we'll have guest speakers. We talk about economic data. We'll talk about tax planning, estate planning. This meeting today is very much going to be tariff focused and thoughts on the market. This is meant to be informative. It's not meant to be a replacement for reviews or individual questions that you may have. So, hopefully you find this informative and helpful. But if you do have a specific question to your portfolio or something you want to address privately, reach out to Chuck or I and we'll talk to you about it. So microphone issues, feel free to ping the chat if there's any issues on your end. But, as always, we do save time at the end for questions. So if you have questions, you can put them directly into the chat window. They come to me, they come as anonymous to the rest of the group here. So no one will see what you're asking specifically. We'll get to as many questions as we can. If we don't get to your question, we'll reach out to you after. So today we're going to talk about, current year-to-date market performance, tariff impacts, and a current updated market outlook, which seems to be kind of changing real time, a summary of our thoughts, and then we'll kick it to questions. So this is kind of where we're at year to date at this point. We had a little bit of a snapback in the market last week. The Dow's down about 5.5% year to date, S&P 8.7, NASDAQ, which is as a reminder, more tech focused, is down almost 12%, which is there's been a good rebound there. It was down 16 or 17% last week, maybe 18%. Russell 2000 is more focused on, smaller companies, small and mid cap companies. It's down almost 16% this year. Equal weight S&P. So that's, takes the S&P, instead of weighting it by market cap, it weights all 503 stocks equally. And so it's going to have less exposure to tech, less exposure to individual stocks. Like, for example, NVIDIA and Apple are 6, 7, 8% of the traditional S&P weighting. They'll be equal with the other 500. So that's down 6%. And then bonds are up a little bit, which may be a little bit misleading because the bond market has been having a tough couple weeks, and we'll touch on that later today too. But kind of all in all, our portfolios we do build custom portfolios, so it's a little bit different for everybody on the call, but we're down an average of 4, 5, some portfolios down 6%. So kind of the more tech exposure you have, the more legacy positions and taxable accounts that we can't trim tax efficiently, those accounts are down a little bit more, but our portfolios are holding up well, kind of doing what we want them to do. And again, we think about that by, we diversify by sectors of the economy. So a little bit different than the S&P and the NASDAQ looks at money.
Okay, so last week we had a tariff pause. So I think when you look at, what's causing all this volatility, it's uncertainty. So the pause was not a solution, but it just kind of paused things. And one thing that we think it showed is the administration's ability to they have a goal in mind with these tariffs. Market's doing what they wanted to do. They weren't willing to let that just free fall. So pause came in. What we still have is policy uncertainty. So we're still in the middle of this. We're in the first, inning, maybe the second inning. So if you think back to COVID and how quick that drop was, all the uncertainty that was built into that. When you look back on it, you think, wow, when you look back on something, now we've lived through it. But during the early days, it was just full of uncertainty. And that's where we are right now with, we have the pause in place. We got a rebound. We're not back to where we were. We're still facing, tariff negotiations, and policy certainty is still what we're dealing with. Good to go.
Right.
Okay, so this we didn't update the slide for what happened over the weekend, but basically, here's the current tariff situation as far as, basically what's going on is we got tariffs classified by the rest of the world and China tariffs. So this is pretty much a China focused. When you look at the highest impact, it's on China. We kind of look at it that the administration's looking at not necessarily only targeting China, but when you look at how they're falling out, it's primarily focused on the inequities of the Chinese market. Over the weekend, technology was exempt from the 145% tariffs. So, that's why you saw Apple kind of have a bounce back. We're going to talk more about, things get better. That would mean the rest of the world minus China, that the reciprocal tariffs would be put in place, negotiations in place. And then China and the US de-escalate. That would add more clarity and make things better. Things get worse. We don't, things are above 10% with the rest of the world, and the US Chinese tariffs remain in place. That would be a worse, not the worst, but a worse scenario. Economic data. We looked at economic data to see what's going on, get an indication of where we're heading. So right now, the labor market's not pointing towards, a recession or signaling worse times. And it started from a strong point, and it's still indicating strength. But one thing about the labor market, that's a lagging indicator. So it's not a leading, but it's a good barometer. Look at the next slide. We'll look at manufacturing. So if we look at the underpinnings of economic activity, we're starting to lose momentum. So it's not signaling a recession, it's signaling losing momentum. And at this point, it's not pointing towards a recession. And we key in on that, on data like this, to see what's going on and where we're heading.
Yep. So we'll quickly touch on this one. This, I think, is interesting, right? If you look at the far right column, this is where these individual, investment banks expected the S&P to end at the end of the year when they are asked this question in January. The column in the middle is where they think the S&P 500 is going to land this year based on, their estimates from last Friday, right? So a lot's changed in 2 or 3 months. I think the general consensus is across kind of the big investment banks is the S&P is not going to perform as well as they had hoped coming into this year, right? So I think that's one takeaway. Another takeaway is even with their kind of current updated year-end 2025 price target outlook, the average is, 5,900. We're at 54, 55 right now. So it's still an increase of where we are today. If you look at the more optimistic banks like Deutsche and BMO, they're still calling for a really good year. The least optimistic is JP Morgan, which is probably another, 3 to 4% decline from where we are today. But I think the moral of the story here is we're all living in uncertain times with data being thrown at us kind of consistently and constantly. And a good example is, last week, the day that Trump did the 90-day pause, Goldman Sachs that morning came out and called for a recession. And then about 2 hours later, they came back and said, never mind, there's not going to be a recession. So no one really has a clear grip on what's going on, but those are some of the takeaways. And, from where they expected us to be and where at the beginning of the year and where they expect us to be now, it's about 12% less from, their expectations, which were very optimistic in January. But we'll see. We're all in this figuring out together.
I think one thing to look, if you look back in January, all these big banks, investment firms thought things could not get any better, right? That everything was just gonna just take off, very optimistic. Everything's in place for, another great year. And then within 2 months, it's the exact opposite story. Things couldn't get worse. The answer is somewhere in the middle. I think the more news you consume right now, probably it's not a good thing. We do look at what major news outlets are saying, to get a feel for what's being said out there. And it's very sensational. It was very sensational on the upside in January. Now it's very sensational on the negative. So the truth's in the middle somewhere, and that's what we're working to, get the data to figure out, where are we heading.
So now we've done this before in the past. We're going to do the good, the bad, and the ugly. We're going to talk about 3 different scenarios. And again, we'll probably fall somewhere in the middle, but kind of a good case scenario for us right now would be rest of world tariffs are negotiated over the next 90 days, and they kind of remain in that 10% range. And at the same time, China and the United States have some sort of ceasefire between the negotiation, and we have a drastic reduce from 140%, and we end somewhere much lower than that, right? In this good scenario too, ISM and PMI manufacturing don't drop below 50 for more than 2 consecutive months. So that was the chart we showed a little bit ago, where there is kind of a downward trajectory right now. The next print comes out soon, so that's something that we're always monitoring. Unemployment rate does not rise above 4.4. We're currently at 4.2, and data continues to look strong. We do expect next print to be a little higher than 4.2, but we'll see when that comes out. Jobless claims do not rise above 275,000. Retail sales don't materially drop. We look at materially as 5% or more from recent highs. In all these scenarios, it means that growth does slow. That's already happening, and that's okay. But if everything else stays positive, it reaccelerates the potential for relief later in the year, and tax relief and deregulation, and kind of Trump's kind of agenda, which starts with tariffs. And it's hard to think further than that until we get past that point. The bad scenario would be rest of world tariffs kind of end somewhere between the 10% pause where we are today and where they were at April 2nd levels, which was much higher. So when things are negotiated, it's somewhere in that middle between 10% and much higher. China tariffs are only moderately reduced in the recent and then in the near term future. We're also looking at, again, ISM. If we see, below 50 but above 47 for 2 to 3 months in a row, unemployment rate rises, goes to 4.3 or 4.4, but not above 4.5. Jobless, comes down a little bit to 250. Retail sales drop. In that scenario, we're looking to see multi-month lows. So, 4, 5, 6 month lows. And this scenario is, again, it's kind of riddled with uncertainty, and it's this on again, off again tariff drama that's weighing on growth, which would stall growth, leaving markets in more of a holding pattern, and then puts us more on the tipping point of a recession or not a recession. And then the ugly, rest of world tariffs revert back to where they were before the 90-day pause. And then China tariffs are not reduced, or very, very minimally reduced. In this scenario, Manufacturing and PMI drop below 50 for 3 months in a row, and they fall through that 47 benchmark that we just talked about. Unemployment rises through 4.5 and pushes towards 5%. Jobs push over 275,000, and retail sales drop, kind of hit, 6-month lows, 12-month lows. And this scenario, we basically revert back to where we were last Tuesday before the pause in tariffs. It puts stagflation back on the table, and it just kind of continues this cycle of uncertainty. Again, we kind of look at it as not everything is going to happen, and all these lists in exactly this order. It's going to be some mix of things happening across the board. We're still optimistic in a good scenario, right? We're confident the current administration is going to get the tariffs organized and renegotiated, but the linchpin remains China. It's the rest of the countries matter, and they're actively kind of in discussions. But there's really, at least as far as we can tell, there's not a lot of good active conversations happening with China, and that is by far our biggest trade partner, and that's the linchpin in this whole tariff thing. So, anything you want to add there?
Yeah, I'd say, to summarize all this would be, when you look at how your money's invested, so first thing that happens, we run the companies through screens, but they're high quality companies that are diversified by sector. So that strategy is working. It doesn't do what we want it to do all the time, but it works. It worked during COVID. It worked during 22. Worked during the financial crisis. We're in the middle of something that there's a lot of uncertainty. So, we look at it as the strategy is holding up. Diversifying by sectors does work. You look at last week, when tariffs were announced, we had the free fall in the markets. Financials, energy, and tech were hit hard. You look at the defensive sectors, healthcare, utilities, and health, food staples were actually positive. So, I think that's another positive sign that it's not every sector. There's certain bright spots, and your money is allocated to some of those bright spots right now.
Yeah. Great. So we'll give you a few minutes for people to put questions in the chat, but we did have a pre-submitted question or two, so let me pull those up.
I think there was one came in, right?
Yeah, this one we've actually gotten 4 or 5 times in the last couple of weeks. So, Nev, what are our current thoughts on gold? Should we be thinking about gold as a hedge? What do we think about the upward mobility of gold from where it is today?
Yeah, so Justin and I just looked at this morning. What gold 20% on the year. So we look at it, if you have an allocation to gold, now may be a time to lighten up on it and redeploy it. We think it would be a mistake to add to gold right now. It's already done its thing. Where you're kind of chasing something that's, making new highs, and people kind of crowded in there already. So wouldn't want to follow the crowd in there right now. Definitely something we can talk about as we move forward.
Yeah, and I think it's okay as a light allocation, right, as a hedge. But when things do get sorted out, and we're still optimistic and hopeful that is sooner rather than later, likely scenario is money leaves gold and goes back towards growth assets, right? Just a matter of when that happens. So it could be next week, it could be 6 months from now, but kind of in that meantime, gold should continue to perform pretty well, but we just get a little bit leery with how well it has performed in a recent amount of time. What are your thoughts on bonds moving forward? It's a tough one.
Yeah, so your bonds move with interest rates. I think one thing that's commonly said, and I think is true, that the bond market is much larger than the stock market. The bond market is supposedly more intelligent than the stock market, not as emotional. So people say stock market's a voting machine and the bond market's a weighing machine. When you look at where interest rates are right now, um, you know, long-term average for bonds is 3% above inflation. So it's about half that of stocks. So you're kind of giving up on a return that can beat inflation being too heavily weighted in bonds. We kind of look at bonds as a placeholder for stability is the job that we see bonds. And we still see it that way. It's not a place to beat inflation. It'll hurt your long-term compounding rate. So we're currently not pushing money from stocks into bonds right now. We don't look at it as a place to, but we do see it as a viable place to have stability, more stability than the stock market.
But even recently, maybe you can talk a little bit about the 10-year and how that's impacting bonds.
Yeah.
And there's a lot of theories around why the 10-year is moving the opposite direction of what we would expect it to do in this current climate. But
yeah, kind of move opposite. You would think with an economic slowdown, if that's truly going to happen, well, then interest rates would move lower, right? But what we saw is the 10-year treasury interest rates move higher. So there's, I don't know, one of the reasons is that bonds are being sold by Japan, China are selling bonds that increases the supply, decreases the price, raises interest rates. So that is certainly possible, but it looked like yesterday that reversed. Rates went down yesterday. So we got volatility in the bond market too. So interest rates moving up and down quite a bit. So it's less volatile in the stock market, but there's still volatility there too.
All right. Another question here is, are there any changes to allocation or anything SevenBridge is looking to with what we know today?
So we recently looked at all the targets for, equities, stocks, the bond allocations, looked at sector allocations, and we tweaked those a little bit. But we're not making any big moves right now. Individual level, we're having conversations. I think I had 40 client meetings last week in Pennsylvania. So lots of discussions on an individual basis. And, I think they're most productive. This call is great, but if there's something on your mind, because everybody's, in the same strategy, but everybody's a little bit different, as far as you look at, together the portfolios perform in a similar fashion. But if you have more tech, you're going to have a little bit more volatility. You got more of a bounce, but you also took more of a decline whenever. So those were discussions I was having with individual clients. That you're, if you're overweight in anything, it's probably tech. And now's not the time to just rip the Band-Aid off that and get it down. I think we, take our time, be patient, be calm, and eventually get those sector allocations back in line. And I think that's what we're looking at. People who are a little bit overweighted or underweighted in places would be to get things back in balance.
Yeah,
that's the main thing we're looking at.
And those same people that were a little bit heavy in tech outperformed, the last 2 years too. So there's kind of pros and cons and trade-offs. But it's hard when things run and they run linear. It's hard, to look at NVIDIA and it becomes 4 or 5% of your portfolio. It can become difficult to trim it back to the appropriate weight just because it's done so well and you get attached to it, and then there's tax consequences. So these are the types of conversations that we're constantly having with our clients. It's, staying disciplined and making the best decisions we can with the information that we have. And I think the moral of the story now today is the strategy is good. It is less volatile in the market. We're convicted in how we think about sector weighting and how we think about that as a really overall measure of risk inside of your portfolio. And when times get tough, we just have to, keep communication lines open, reach out with anything that, any questions or anything that pops in your mind. But, now is the time when things do get a little bit hard, is to stay the course. And that's the biggest mistake that, our clients are not making. But if you look at traditional retail investors, people doing it themselves, they get an average return of 2.4% per year versus, a 10% return that we would get, or 9 or 10%. And it's not because they're, buying all that different stuff. It's because they're trying to time the market, and they're selling when they're scared. They're buying when things look attractive, right? So those are the things that we're being mindful of. Now it's not the time to go chase a bunch of growth just because it's been down a good bit this year. It may be a time to add to it, but it's not a time to flip, your whole strategy and say, well, let's sell industrials, let's sell financial services, let's go chase Tesla and Nvidia that are down. You have to stay consistent with the strategy, make micro adjustments when it's appropriate, like we did coming into this year. And then, we're long-term investors, and so are you. It's, what happens in a short period of time can be challenging, but we just have to continue to look at, win the war, not the battle.
Yeah. I know one analogy I used last week during all my meetings was kind of, you're driving down the highway, you hit a patch of ice, and you can't even see the end of the patch of ice. I mean, the first thing to do is take a deep breath, try to remain calm. Don't jerk the wheel, don't slam on the brakes, don't hit the accelerator, but you're heading towards going off the road, you need to do something. So it's not don't do anything, but it is pay attention, stay calm. Yeah, that's more important, because these decisions we make now have a high impact. It's a high impact time. So don't hesitate to reach out. We're here for you. And, the decisions we make now will have a great impact.
Great. Any other questions that we didn't get to, or more personalized to your portfolio or your situation, please reach out to us. And we kept it under 30 minutes. So that's a win. And we look forward to doing this again next month.
Apparently.
Yeah.
Have
Thank
a
you
good
all
day,
for your,
everybody.
appreciate it.